Hello, I'm Richard Hunter, Head of Markets, and welcome to our look ahead for the week commencing the 31st of July. Been a fairly positive week again, generally speaking, on both sides of the pond, especially in the States. We had a 0.25% interest rate hike as expected. The question now, of course, is whether there's one more to come or whether the Fed is now done. The Fed is very much hedging its bets that things will remain data dependent, and so it's leaving the door open for potential rise in September, although that's not currently being priced in by the markets. No doubt the US economy is still showing resilience, strong GDP numbers again, and falling inflation all helping to the mix. So in the year to date, the Dow Jones currently up 6.4%, S&P 500 up by 18.1%, Nasdaq still powering ahead up 34.2%, FTSE 100 back in positive territory up 3.4% so far this year. Looking to next week, we've got half-year numbers from HSBC, which will close the current reporting season for the UK banks. Shares up about 27% over the last year, largely predicated on the reopening of the Chinese economy, even though the macro situation there is looking a bit more undecided at the moment. Even so, it's the best performing bank over the last 12 months. So again, as we've seen with the other banks, look out for those key metrics, the return on equity and so on. And net interest margin, which has tended to be something of a disappointment from the UK banks so far this week. Also, financial largesse remains possible, currently yielding around 5%. HSBC may well raise its dividend again, could even announce a further share buyback programme which will be supportive to the share price. And of course, any updates on its recent acquisition of Silicon Valley Bank UK could also prove interesting. Next has a second quarter trading statement, shares up around 5% or so over the last year. It recently had an unscheduled trading update which was extremely positive, so we'll see whether that momentum has carried on and whether indeed its full price sales are adding to the bottom line. There's also the ongoing dynamic between physical store shopping and its online presence, so there should be plenty to look out for there. And finally, Taylor Wimpey half-year numbers. Obviously, house builders have been under pressure, rising mortgage rates, general cost of living, etc, etc. Shares down about 9% over the last year, which isn't too bad a performance, particularly bearing in mind the fact that investors are being paid to wait in terms of a dividend yield of just over 8%. But again, reservations and indeed cancellations will be the order of the day to look out for. On top of that, of course, in terms of the forward order book, this will give a good indication over a busy summer period, traditionally one of the busiest for the house builders, of whether Taylor Wimpey is holding its head above water. Thank you for watching. Have a great week.